The first question is, if the US Federal Reserve cuts rates at the December meeting, will they maintain a dovish bias into 2026? Well, the next meeting will also get the updated dot plot of rate predictions. Currently it shows an easing bias through next year. And given the underlying stresses discussed earlier, the Fed is likely to maintain this bias. And they may even highlight the other policy tools that they can use to reduce market stresses, should they now arise. Therefore, they should maintain a dovish bias into 2026. And a follow-up question to that one was, would that easing bias put pressure on the US dollar? Well, as we've seen, the dollar has been in an uptrend against many other currencies recently. And if the US is cutting rates because global risks are rising, then the dollar could easily be seen as a safe haven, which has generally led to a stronger dollar. In fact, the dollar is more likely to come under pressure during periods of strong global risk on, rather than periods of risk off. Now switching to equities, we have the question, is the US equity market a bubble at risk of collapse? Now, on most metrics, the US equity market does look stretched, but it's not ridiculously overpriced. It is highly concentrated in a few themes, but as long as those stocks continue to attract that capital because people like those themes, then these stocks will obviously still be supported. The biggest risk to equity markets is therefore probably the risk of that bond market volatility that we discussed earlier. And finally, we turn to the crypto arena. Will increased global liquidity in 2026 be beneficial to Bitcoin? Now, whilst there's no guarantee that we get more liquidity next year, if we do, then the simple answer is yes, because Bitcoin is at the center of that liquidity risk-on, risk-off matrix. If policymakers preemptively provide new liquidity, then Bitcoin, along with other high beta assets such as tech stocks, should do okay. However, policymakers have not yet pulled those liquidity levers, and they may not need to.